Fitch Ratings held a conference in Paris this week on the future of the bond market in the light of Solvency II. We have met with Clara Hughes, director of the insurance group at Fitch Ratings, who presented the impact of Solvency II on the insurance sector and on ratings during this conference.
One of the impacts will be that companies will hold risk-based capital rather than a fixed margin. Currently they just hold a fixed margin above prudent liabilities, but they're going to move to holding capital in line with the risks on their balance sheet. So if they're holding a lot of equity, then they'll have to hold capital to cover that risk, the risk that those assets fall. Also on the liability side, they'll have to hold capital for any risks on that side as well. I think if you look at the top figure of Quiz 5, which is 355 billion of surplus over the SCR, then things could look quite rosy. But the calibrations for Quiz 5 aren't final. There's going to be a lot of changes before this goes live. And at Fitch, I think we see positive moves in terms of that capital. In fact, rather than negatives, there's a number of outstanding items that could change that figure. Obviously, improving risk management is one of the most important parts of Solvency II. And for our universe, which tend to be bigger, more established insurers, that probably isn't going to make that much of a difference. But further down the scale, in less developed economies and markets, that could be quite a positive for insurers and therefore for ratings. Broadly across the portfolio, we don't expect big changes in ratings because of Solvency II. But there's a possibility that some niche market players could be affected if they don't have diversified portfolios. Because diversification is one thing under Solvency II that does get a lot of benefit.